Welcome back. Now, India's merchandise trade deficit in August hit a 10-month high of $29.7 billion, which was up 7.2% over the July deficit and 24% higher than the year-ago August deficit. Now, the rise is mostly due to higher gold imports. Latha Venkatesh is joining in with more on this. Latha, good morning. What are the numbers looking like?
Well, good morning. Actually, when you hit $30 billion trade deficit per month, it should create a flutter. So let's just analyze how bad is the news, if at all it is bad. So goods trade deficit, as you pointed out, it has shot up because of gold, and gold imports have surged because, if you remember, two months ago, duty was cut. As well, we are standing on the start of the festival season. Ganesh has just happened, and then you've got Dasara and Diwali waiting. These are usually times when gold imports surge. So July gold imports was 3.1. And guess what? August gold imports is $10.1 billion. So the entire rise in deficit seems to be accounted for by this higher $7 billion. On the other hand, exports were not making up. Exports actually fell 9.3%. If you look at it year on year, in July also they had fallen. They had fallen 1.7% in July. This fall is a bit pronounced. The fall is largely due to a contraction of oil exports. India imports crude oil, but value-added products are exported. Now, because crude has fallen, value-added products have also fallen prices. Therefore, you are seeing a fall in those petro-product exports. That's contributed to the fall in exports. Non-oil exports actually have done as well as they did in July. Electronics, chemicals, textiles, engineering goods, all these important heads have done reasonably well. In terms of imports, merchandise imports, that is not counting crude, merchandise imports are up 3%, and that is up compared to 7.5 year ago in July. So merchandise imports have not risen much, and they've not risen much largely because, again, crude prices fell. So the bill looks smaller. In fact, Goldman Sachs report says that the imports are actually showing that we are importing more investment products, that is, capital goods, and less of consumption. So we shouldn't be terribly worried. The point is whether we should worry about this overall trade deficit of $30 billion. Why we don't worry? Because of what you're seeing on your screen, trade surplus. In services exports, our services exports have done very well. Again, this month also growing at 6.9%. Imports of services have also grown, but the trade surplus of 15 billion, you put it along with the trade deficit, then the deficit becomes only 15 billion. Because you've got a surplus in the services sector. Services, therefore, will ensure that we will keep the entire current account deficit in the ballpark of 1 to 1.2% of GDP. I interviewed a couple of economists. They're not terribly worried about this. So a high deficit, but not to worry. Services have come to the rescue.
To worry or not to worry is the question, right? Latha, thanks a lot for summarizing the August trade data.